Hey, Andrew here from the Investor's Way, and welcome to Woody's Weekly Wisdom, episode number 59, as we look this week at the latest headline and see what's happening in the news and reflect on how that might be impacting your money and your wealth creation activity. Before I dive into the article, do me a favour. If you're watching on YouTube, hit the subscribe button and the little bell to get notified when we release these videos. And if you're watching on Facebook or YouTube, LinkedIn, then hit the like, the comment, and the share buttons, and let's get this information shared as much as possible so that we can get more and more people understanding how to look after their wealth. So this week we're looking at this article: Uni of New South Wales economics expert warns of stage 3 tax cut inflation risks. So as per normal, a little bit of a warning or fear in that headline about what might be coming because of these tax cuts. And if you've been living under a rock and haven't heard, you actually got a tax cut on the 1st of July. So a couple of weeks back, you should be now as a result receiving a little bit more in your afterpay salary, wage, whatever you want to call it. There's a table further down in this report that will show you roughly what to expect if you've not heard what to expect. But this article is basically saying that the economist from the Uni of New South Wales is suggesting that there is a risk that if people use this extra money to go on a spending splurge, then we're going to be in a whole new world of pain when it comes to inflation. And as a result, more than likely, more interest rate rises are coming. So, the amounts, for a lot of people, they're probably looking at it saying it's not a great deal of money, so why would I splurge on it? But it is historically what happens when people get a tax cut, is they go out there and splurge it on, whatever it might be. But I think, in terms of what we've experienced over the last 12 months for a lot of people who have seen their mortgage payments increase dramatically over the last 12 to 18 months, a little bit of relief in the pay packet is really only going to help them with meeting their household expenses. But it is a valid warning to suggest that we shouldn't be splurging that money on more spending. As much as I'm not a big fan of the way the government uses interest rates to stop us from spending, when we all know it's very much a circular argument. So if the interest rates keep going up, then people in business or investors who have properties are going to have to put up the rents and put up the costs of their products. And that flows through to the consumer, who then is spending more, which then leads to more inflation. So, I've ranted about that one many, many times, and it doesn't matter how much I rant about it. I'm not going to change the fact that they use interest rates as a bit of a sledgehammer, even though it is a circular argument. But we saw back in May a little bit of a surge in inflation again, and the CPI rising, and that put a little bit of fear into the Reserve Bank and economists generally about where the next direction for inflation was, and therefore what that meant for interest rates. And so there is this fear permeating around in the media and in the financial world about the next interest rate movement potentially being an increase as soon as even August 25. You can see the August Reserve Bank meeting suggesting a 25 point increase to interest rates to get it up to 4.6% from its current 4.35. So here's the table I was mentioning. This is what you can expect in terms of the tax cuts. These are annual numbers, I believe. And so, they are annual numbers. So they're not huge amounts of money, roughly about $40 a month, I think, for the majority. I think it was mentioned further up here. $42 per week is the average take-home pay reduction in tax or extra amount of money that you're going to have. So, like I said, for some of the higher earners and average earners, it's a little bit more. I think generally they're up around the $70 a week for the higher income earners. And so it's not an amount of money to be sneezed at. And in order to beat this inflation risk. Here is, I'm not going to go into the rest of this article. Basically, it just talks about the risk to inflation. And sorry, the one thing I will point out is that the NAB are saying that a third of people are going to just are not intending to splurge the money. 53% of Gen Z will say that they're going to save it. And those earning between 100 and 150,000, 49% of those say that they're going to choose frugal measures over extravagance. So, top of the article, the fear is, that we might spend it on, luxury items or just general spending. And then the bottom of the article says that the majority of people are thinking a little bit more intelligently about how they might spend their money. So what are the options available to you? This is probably something that I think is more important than the content here, but what are the options? And look, what I've been talking to my clients about is that that money, $40 odd, $70 odd, whatever it might be a week, you've got a couple of really intelligent, smart money options that you can take. So the first one is to put it into your mortgage. And if you've got a home mortgage, get that non-investing debt down as quickly as possible so that there's more money available for investing down the track. So that's the first one. And the other one is to take advantage of the personal super contribution tax incentives. And maybe it's something that you could think about doing if your mortgage is under control or you're already paying ahead of the normal rate on your mortgage. Maybe the better option for your extra tax cut savings is to make it a personal contribution into your super, and that way you can get your super balance accelerating to provide for your financial future. And the thing here is that this money, this $40 or $70 a week, or everything in between, is money that you've been living without. So we want to take advantage of the fact that if you can continue to live without that money, let's put it to something that's going to change your financial future over the long term. And it might not seem like a lot of money, but if you get that money working for you for longer for longer periods of time, 5, 10, 15, 20 years of time, those numbers will accumulate to being much, much bigger numbers than you can probably imagine. So take advantage of the fact that you have been living without this money and put it to good use. And if your mortgage is under control and you're already making extra payments on your super, then I would highly recommend that you use this additional funds for investing purposes. So add it to your pay yourself first money. And of course, if you've been watching my videos, you know what your pay yourself first money is, and you have one. And an extra $40 or $70 a week is just going to ramp that up so that you've got more money to put into your future wealth so that you can invest it, grow it, and get that money working for you so that you don't have to spend the rest of time working in order to meet your lifestyle expenses. So I think that's a good summary of this article. Like I said, there's a little bit of fear up top about the impact that this could have on interest rates. I still firmly believe that another interest rate rise would be crazy in our economy, despite all the data that might be suggesting there's underlying, they call it underlying inflation out there. The simple fact is that another interest rate cut is only going to fuel more price rises and fuel more inflation. There's a popular Instagram reel going around today, and I actually saw, when I was looking for this article, I saw that it's on this news.com.au website as well, where a guy is talking about the fact that he just paid $249 for a day pass in the ski fields. And back in 1990, he recalls that he paid only $46 for a day pass. So he put those numbers into an inflation calculator and came up with a number that would suggest that, based on the inflation since 1990 till today, that ski pass should have only cost him about $107. And he said, obviously, because GST didn't exist back in 1990, he has to add that to make it equivalent. So that gets him to about $118. And here he is being charged $249. So this is my point, that inflation is something that businesses use as an excuse to ramp up their prices, which is only fueled by more and more interest rate rises, and that all just leads to a self-fulfilling prophecy. So if we want those prices to calm down, then we need to do what needs to be done to stop the excuse of inflation for prices going through the roof. Another rant for you, but simply put, we need to be proactive ourselves. So if there's any message out of this, other than you've got a couple of options of what to do with these tax cuts. So like I said earlier, pay down your mortgage more quickly with it, put it into super as personal contributions, or if both of those are taken care of, put it towards investing for your financial future. Get it into some investments. But whatever you do, don't give the Reserve Bank any other option to put interest rates up. Let's do our bit to rein in the interest rate beast, and let's get this inflation under control so that people can get back to a normalised level of interest rates and a normalised level of inflation, so we can all get on with growing our wealth and managing our money a whole lot more simply. Hopefully that was helpful. Like I said at the start, give us a like, comment and share. And if you're watching on YouTube, hit the subscribe button. That's Woody's Weekly Wisdom, episode 59. I'll see you again next week for another episode. Cheers.